Morning, ladies and gentlemen, and a big warm welcome again to Boutiques on Wednesdays. And Olga, thank you very much for that upbeat music. It makes you ready for the day and the rest of the week, most definitely. We are officially at the halfway mark of the year, and global financial markets are closing out the first half of 2026 in a full risk-on mode, propelled by an aggressive technology rebound. On the flip side, the JSE headed towards the worst quarter slump since 2024, with extreme volatility in commodity prices, as you all know. The all-country world index recovered and is supported by earnings upgrade, while some counters on the JSE are really facing some big growth headwinds. Today, we will focus on local and global equity and some of the opportunities in both sectors and some very interesting strategies that are followed. We are joined by two specialists in their fields, and it is my pleasure to welcome William Short, Portfolio Manager at Flagship, Philip Short, Portfolio Manager at Flagship Asset Management, and Radamir Vermaak, Head of Systematic Solutions at Stanlip Asset Management, who is the appointed Portfolio Manager on the Amity BCI Equity Fund. Good morning, Philip. Good morning, Radamir. How are you doing this morning?
Morning, Eugene. All good and well. A little bit cold in Cape Town, but good, thank you.
Morning, Eugene. Yeah, good to be here. Thank you.
Thank you so much for your time this morning. I had a brief preview of your presentations. It does look fascinating indeed. To our audience, while Philip is getting his presentation up, you know how it works by now, the Q&A bubble. If you want to post questions, you're more than welcome, and we'll deal with those questions after both presentations. Philip, if you're ready, I can see your presentation coming through. Yes, got it.
Great. Thanks, Eugene. So today I'm going to be talking about investing locally versus the option of investing globally. I think it's a topic that many have considered or at least come across. But I think there's some interesting facts and some sound bites that one can add to that. Investing globally not only offers investors a lot more opportunities, but it also increases diversification and reduces an investor's risk profile. So usually with these presentations, I like to start off by seeing where we are in terms of global markets. Here we have the blended or the 1 year forward price to earnings or PE of the all country world index or EQI, and used by most global equity managers as their benchmark. And we can see that it's trading at about 17.5 times PE forward, which is about 7-8% ahead or above its 10-year median. So somewhat expensive, not too expensive as it was maybe perhaps a year or two ago. And the question is, why or how do markets stay expensive or somewhat expensive? And one of the reasons is strong earnings growth. So what we can see here in the red line is the EQI on the left axis, the red line. And the other line is the 1 year forward, is the calendar year 2026 earnings per share for EQI forecast. So if we look at the bottom left, we can see in Jan 2025, sell-side consensus or the market was pricing that for the year ending 2026, EQI or the companies within EQI on an aggregate index level would be earning $50 per share or per unit. As the time or 18 months have progressed, companies within the EQI have beaten earnings estimates, and so analysts have had to upgrade their earnings. And that has resulted with earnings going from $50 a share to $60 for the same year ending 2026. So that's a 20% increase in earnings, which is pretty strong. So as earnings have increased and beaten expectations, so that has supported share prices and the indices. Same slide here, but also including estimates for 2027 and 2028. You can see how the market has been increasing the estimates for those years. If we look at South Africa, it's a slightly different story. We can see that earnings expectations have come down for the years ending 26, 27, 28. The downgrades have started coming in the beginning of this year. That's largely on the back of weaker resource index, general retail, and with modestly increasing financials and industrials. So to put into context, or to put investing globally into perspective, consider this. South Africa makes up 0.4% of the world's GDP and only 1% of the world's market cap. South Africans' equity allocation to the local market, or JSE, on average is about 65%, yet that same market only makes up 1% of the world's market. So while a fair share of the companies on the JSE make money from global markets, you're still restricted to only, let's say, one tobacco stock that's listed on the JSE, British American Tobacco, and there's over 20 tobacco stocks listed globally. One beer company, ABI, although there are 50 beverage or alcohol companies listed globally, and one Chinese internet company via Naspers. And we know that there are hundreds of IT and internet companies listed globally. So the bottom line is putting the majority of your equity or your client's equity investments into a 1% opportunity set is really maxing out the adage of putting all your eggs in one basket. So putting these opportunities into context, on the left-hand side, we can see that the number of sectors in ACWI, the All-Country World Index, that's sitting at 163 with 60 on the JSE. So to give you an example of a sector and a subsector, a sector would be let's say IT, and a subsector within IT would be semiconductors, software and services, hardware equipment, electrical components, and so on. And you'll see like a lot of those aren't even offered on the JSE, so you're not even getting that exposure. So it's not about duplicate companies like another tobacco stock, but it's just exposures like semiconductors, which you just don't get on the JSE. On the right-hand side, we can see that the number of mid to large cap companies within the ACWI, the All-Country World Index, is over 2,800 companies, while the total number of listed companies on the JSE is 119. So that just speaks about the opportunity set that we have. So digging a little bit deeper in terms of the global exposure that's not even found on the JSE. I quite like this picture. This is an SR-72 Dark Star from Lockheed Martin. Should be released this year or the next year, and sits in the aerospace and defense sector, something that we don't have on the JSE. Interesting bit of information. This plane can go at Mach 6, which means that you can go from Cape Town to Joburg in 15 minutes. Then we've got something that we're hearing about lots in the press lately, and that's the AI and semiconductors specifically. You've got CPUs, computer processing units, GPUs, graphic processing units, and memory stocks. We don't have that on the JSE. Gene editing and splicing. A company like that would be CRISPR Technologies. We don't have that on the JSE. Humanoid robotics, South Korea, Japan, China, and the US. We don't have that on the JSE. Something that we do have in South Africa, but not on the JSE, is electric utilities. So that would be something like an Eskom. It's a really useful sector to be invested in when it's time to get defensive, as everyone's using electricity. There are over 30 listed electric utility companies in the US alone. And then something quite fun for some, not for me, but cruise lines, so like Royal Caribbean and Caribbean Carnival or Carnival Cruise Lines. To give you an idea of some of the stocks that we've got in our portfolios and a few of the alpha generators in our global portfolios, and granted we have had our fair share of losers as well, but that's the game. These stocks have done over 100% since we've included them in our portfolios. We've got Micron Technologies, which is a memory chip manufacturer, Howmet Aerospace, which makes specialized parts for airplanes, Rolls-Royce Holdings, the cars, this is not the cars, but the jet engines that go in airplanes. A Spanish construction company, Actividades de Construcción. I'm still working on how pronouncing that, but that's done pretty well in Spain. And then Credit Corp, a Peruvian bank, Mitsubishi Financial Group, a financial conglomerate in Japan, and TSMC, a chip manufacturing company in Taiwan. So really accessing opportunities globally across geographies and sectors. So as I mentioned, investing globally gives you opportunities worldwide, but also reduces your risk by increasing your diversification. If we look at the materials weighting on the JSE at the moment, with our precious metals contributing 30% to the JSE, I know a lot of friends and peers that are SA fund managers that are sitting with the dilemma of what should they be investing in gold and PGMs. Where on ACWI it only makes up 5%. On the flip side, we do have IT, which makes up 30% of the ACWI index, but you have, as shown earlier, we have a lot of subsectors within there. So where you've got materials, which is basically just gold and precious metals, in IT, you've got semis. Within semis, you've got CPUs, GPUs, and memory stocks. You've got hardware, you've got software, etc. So there is a concentration risk currently on the JSE. In ZAR, with the high inflation, it does take away some of the value from the rand a lot faster than hard currencies. $1 in the year 2000 is worth 50 US cents today from an inflation point of view, and 1 rand in the year 2000 is worth 20 rand cents or 20 South African cents today. So even if you left your money in the bank and you didn't even access opportunities, you'd be left poorer just by invested in ZAR. ZAR is also one of the more speculative currencies in the world, and hence a lot more volatile than the hard currencies. So it would be better to diversify yourself just from a currency point of view. And not to say that South Africa is the only country with the political issues. We know that there are issues even in the once rosy parts of Europe and America. But South Africa is quite unique in how we are anti-investment or investor capital. I'm sure you've heard this saying before, that capital goes where it is welcome and stays where it is well treated. And South Africa, unfortunately, as I said, many countries have their problems, but one thing that we don't seem to be very good at in South Africa is attracting investor capital. On that note, one thing as South Africans, where we think of ourselves probably from a nostalgic point of view, but is gold companies. We are in terms of resources, South Africa is the third largest resource country when it comes to gold, but we are only the 10th largest in terms of how much we produce. A lot of that is from deeper reserves and rigs, but also just from a legislation and political point of view of how we attract capital. So if you're looking from a global perspective and you want to invest in gold, South Africans would like to think that we are front and center of where investors would want to invest. But if we look at the world's top 20 by market cap for gold companies, you can see that there's only 2 South African companies that really sit in that top 20. And a lot of the other countries, as you can see on the top left, middle left, and bottom right, are really investor-friendly countries. So even when you want to invest in gold, South Africa is really not the first country that comes to mind. So I suppose that asks the question, so why do people all over the world, and it's not just South Africa, but all over the world, people disproportionately invest in their local market versus the global markets relative to the size of their local markets in the global index? And it comes down to behavioral finance. And it comes, I think it's coined as familiarity or home bias. And we invest in what we know or what we're comfortable with. This is just made me think of when I was a lot younger. I remember whenever we went out to eat, which wasn't often to a restaurant, but I'd always order a cheeseburger and a Fanta grape without even looking at the menu. And it's just something that I knew that I'd like. I knew it was just something that was hard to mess up and I'd be happy. So, it's going beyond finance, and it's about how we think about familiarity. And familiarity, is about seeking comfort, which in turn does breed complacency and ultimately would lead to stagnation. So my message to everyone out there is that it's a big world out there and it has an awesome menu. So look at both sides or all sides of that menu and see where you want to order. So when you have this massive universe that you're investing in, it's important to have a rigid, as much science-based philosophy as possible. And at Flagship, we look at fundamentals. And within fundamentals, it's looking at the strength of the balance sheet, free cash flow, PEs and PEGs, which is your PE over growth. We look at macroeconomics and technicals, so central bank policy, global liquidity and inflation, and then quant factors, which looks at valuation, profitability, growth, momentum, and earnings revisions. And something that sits where we can find a stock that all 3 of those circles or boxes that are ticked sits in the middle of that Venn diagram. That's when we get very happy, and that's where we would ultimately invest. And this investment philosophy has its foundational basis in the following. So we've got Warren Buffett, who is the fundamental investor, who looks at moats and cash flows. And I think he's, for the last 60 years, out of the 40 of those 60 years, he's outperformed the S&P 500 with an annualized return of 20%. Maybe lesser known, but maybe well known in investor circles, is Stanley Druckenmiller, who's more of a macro top-down investor, also looking at technicals, looks at central bank policy, where interest rates are going, has returned 30% annualized and hasn't had a down year in over 30 years. And then probably the best investor out there is Jim Simmons' Medallion Fund, has done gross returns of 66% since inception in 1988 and hasn't had a down year since 1990. And that fund uses pure quants. So we think if we can use all three of those, we have a better chance of success. A chart I've showed a couple of times, but I don't want to waste too much time, and I'm going to focus on the one point here, is that at Flagship, we truly are global. Our first fund was launched 25 years ago in 2001 and was a global fund. I think most of our peers in South Africa, they first invested locally, and as they got larger, they started investing globally. So we see ourselves very much as a specialist global investor, having our main focus on global markets as opposed to local markets. This was the fund that I mentioned. It was the Worldwide Flexible Fund, launched in 2001, and shows that for 25 years we've been able to outperform our benchmark. This fund is pretty much meant for people or folks that are residing in South Africa that want global exposure, want global opportunities, diversification, want to avoid a weaker rand and higher SA inflation, but still want those global opportunities. And then a fund that is a bit more recent that JD Hayward and myself have taken over in July 2024. This is the Global Equity Fund. We've returned just shy of 23% annualized in US dollars versus equity of 21% and our peer group of 17%. Both this fund and the Flexible Worldwide Fund have a ZAR and a US dollar entry point. And that's pretty much my message. I think, it's a big world out there. One should go outside your comfort zone, invest globally. There's exposure that you just don't get on the JSE, and partner with someone that has been doing it for a long time. And that's my message. Thanks, Eugene.
Philip, thank you very much. A lot of questions coming in from the audience, and we'll cover that afterwards. But I'm first going to give Rademacher an opportunity to present. Rademacher, Philip might set you up very nicely because you're going to focus mainly on SA equity. Well, let's see.
Go with it. All right, so I'm talking about the Amity BCI Equity Fund. And in this fund, which is a South African equity fund, so we partnered with Amity to produce something really unique in the SA equity market. And to position why this is something unique, I need to tell you the story of freestyle chess. Now, chess is a very old game, and it's played by people all over the world. And chess players are typically rated, and their experience depends on their innate talents, their ability, and of course their experience with playing the game. Then in the 1960s, IBM started to attack this problem of chess playing with computer software and hardware. And in 1964, they created a chess playing engine called Deep Blue. And that chess engine beat the world champion of the time, Garry Kasparov, at a very famous game of chess. And so the chess engines reigned supreme for a number of years until the very same Garry Kasparov came up with the idea of freestyle chess. Now, what freestyle chess is in chess tournaments, historically, you could only enter the tournament as either a human or as a chess engine. And Gary Kasparov came up with the idea of freestyle chess, where a human and a chess engine can form a team. And what's really interesting about this freestyle chess tournament, the very first one of these freestyle chess tournaments was actually won by such a freestyle team. And ever since, freestyle teams have reigned supreme over both chess engines and humans playing chess. Now, I want to apply the same analogy and the same way of thinking to active equity investing. In active equity investing, there are two schools of thought, and Philip touched on it in his presentation. There's the Warren Buffett discretionary active equity investing, and then there's the Jim Simons pure quantitative equity investing. And the difference between the two is really that the way that the strategy is implemented. Discretionary fund management, such as Warren Buffett, depends very much on the human's innate ability, his talents, and his emotions, and his ability to construct a portfolio that is market beating consistently. On the other end of the spectrum sits the purely systematic or investment engines, where the investment decisions are made very much on a rules-based methodology. And this is also based on fundamentals. It is as intuitive as, for example, if a company's ROE is decreasing and its volatility is picking up, then reduce the exposure in the company. Now, both of these investment styles have done exceptionally well through time. And I think Philip set it up perfectly with pointing out the annualized returns of Warren Buffett and Jim Simons. And so what we are doing with this fund is we are taking it one step further. We are building into the future with a fund that is the freestyle of equity investment. It is the combination of human insight, ingenuity, and talent with the rigor and discipline of an investment engine. Now, what makes this fund different is exactly that point. It combines a high conviction active equity engine with deep human insight. Now, we have been managing equity portfolios for Amity for more than 10 years. And in those 10 years, we've generated significant outperformance. But the question arose, can we do even better? And that was the genesis of this fund. The 10-year equity portfolios that we've managed for Amity was run on a very constrained basis, where the engine was really strictly controlled in terms of the amount of risk that it is allowed to take. And the question was, could we do even better if we unconstrain the engine, if we take off the shackles and we let it run free? And the answer is yes. So if we test that, the answer is a significant outperformance over time. But the engine by itself does take significant risks. And it is possible that there are potholes in the road that the engine could miss. And therefore, we apply a deep human oversight and risk management to the fund to ensure that we avoid those potholes with the high conviction investment engine. The fund makes use of advanced data and technology in its investment decision making and its risk management. And then we apply fundamental active investing principles and strategies to the portfolio construction to add an additional layer of discipline to manage that risk. The risk management is done through strategic fundamental overlays, where we only ever, from an overlay perspective, reduce risk back to the benchmark. So we never put on additional risk. We only ever manage risk downwards to ensure we miss any potential potholes. And the holistic view that we use, our philosophy, is that we invest across the quality, value, and growth styles, which means that it is a blended portfolio that is balanced across these different investment styles, which means that Amity and our clients never have to decide or determine when to buy into quality as a style or when to buy value stocks. Now, why this framework beats the pure investment mindset of a human is best proven by this quote by Warren Buffett. And that is, to invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or even inside information. What is needed is a sound intellectual framework for making your investment decisions, and then the ability to keep emotions from corroding that framework. And so I want to take you through our sound intellectual framework. We invest at the intersection of quality and value and growth. And another way to say that is that we try to find profitable companies with attractive growth prospects and to buy these at discounted valuations. How do we do that with our investment engine? Well, we look at the market through three different lenses. The first is the lens of quality, where we build a holistic perspective on the quality of the company. We look at the balance sheet strength, we look at the quality of the earnings, we look at the risk of the company, and we give every company a quality metric. If a stock is in the top half, say in the best half by quality, it falls within that bucket. The next lens we use is that evaluation, where we again build a holistic valuation analysis and evaluation of every company. And if a company is in the top half by value, in other words, it is one of the cheaper companies in the market, it falls within that value bucket. Otherwise, it falls outside. And the third dimension we look at is the growth of the company, where we look at the earnings growth, we look at earnings revisions, we look at price momentum, and we build a holistic growth perspective on the company. If a company has got the best growth prospects in the top half, it falls in that growth bucket, otherwise somewhere outside. And where we try to invest is at that intersection of quality and value and growth. So in that beautiful flower, ideally in the pollen in the middle. And then having this well-grounded and fundamentally sound stock selection philosophy, we apply a best-in-class risk management framework around that stock selection, where we control for the liquidity risk of the fund, the macro risk of the fund, the correlation risk of the fund, and of course, importantly, the idiosyncratic risk of every stock and every sector. Now, building on those investment petals, that beautiful flower that I showed before, it gives us a good stock classification framework. So if a stock falls outside of the top half by all three buckets, so it's bottom half quality, bottom half valuation, and bottom half growth, we call those stocks worst in class. Then we look at the traps. So a value trap, very well known, it's a stock that's only cheap, but it's cheap for a reason. It's got low quality and it's got no growth. Quality trap is a high ROE company. It's a company with great quality, but it's expensive and the market is not expecting any growth in that company. And then a growth trap is a stock where there's price momentum, there could be earnings revisions, but the company is expensive and the company is of low quality. So we avoid those. If we then move into the flower, obviously the pollen is best in class and we try to find as many opportunities in this bucket as possible. And then we also sometimes invest in the petals, where if we look at the top left petal, quality at a price, those are stocks of high quality with good growth prospects, but they are expensive. A contrarian company is a company that is good quality, it is well priced, but the market is not yet pricing in a growth vector. So there's no price momentum yet, there's no earnings revisions. It's a contrarian stock to buy into. And then the restructuring petal is a company where there's strong growth, it's well priced, but the company needs some restructuring to improve its profitability, its balance sheet, and its quality. Now, if we keep on buying stocks in that those investment petals, we build a high conviction portfolio using the investment engine, and then we apply those risk management overrides. And a couple of examples of the overrides that we've applied historically is that the investment engine by itself was severely underweight Sasol, and we actually reduced that underweight back to the benchmark on the operational improvements and the stronger oil refining and chemicals backdrop of Sasol even before the Iran war broke out. On Glencore and Exxaro, we had the positive active weights that we maintained based on the strong quality, value, and growth scores. So within that flower and the potential for coal price upside. In Pan-African Resources, we reduced the active weight to manage the single stock risk and the potential for a weaker gold price outlook. And in Standard Bank, we reduced the underweight. So we bought into Standard Bank a little bit as the ROE delivery improved and as the African growth story supported earnings along with commodity tailwinds. Now, if you keep on buying into the stocks that are best in class and into the three petals, you end up with a portfolio that has got fundamentally better characteristics than the benchmark. So if you look at the fund, now this is only from 2024 when the fund launched, but we know that from the 10 years that we've managed equity for Amity, that this same pattern holds through time. If you look at the value dimension, you can see that in December 24, our fund had a higher dividend yield than the benchmark, the capped all share. It was more expensive on a forward PE and a price to book ratio. In March, it was cheaper on both metrics. If we roll forward, you'll see that the fund was priced more or less in line with the benchmark, sometimes cheaper and sometimes more expensive. However, in the other two dimensions, if you look at the quality, you'll see that we had built a portfolio that is of consistently higher quality than the benchmark and with consistently better growth prospects. So if your fundamental hypothesis is, if we just look at stocks, that a stock that is well priced, with high quality and with good growth will outperform a stock that is expensive with low quality and no growth, then you already intuitively understand why we have outperformed historically and we believe we will continue to outperform in the future, because our portfolio has got better valuation, better quality, and better growth dimensions than the benchmark, and therefore we believe we will continue to outperform the benchmark. So in summary, why the Amity BCI Equity Fund? It generates uncorrelated alpha, which means that it combines very well with other active managers and gives you better portfolio diversification. And there's a free lunch on the table if you allocate to this fund. It has superior risk management, which combines human skill and mathematics that ensures persistent outperformance. The team behind this are experienced and at the cutting edge of investment evolution. The strategy is rational and based on the fundamental principles of active investing, buying into stocks that are of high quality, good growth, and at decent valuations. And we build a portfolio that is better than the benchmark. The portfolio is also diversified from a style perspective, which means you don't need to call the cycle in order to generate superior returns. And the process is disciplined and repeatable, where data and technology infrastructure supports the portfolio construction and the human oversight adds the final elements in the final layer. So Eugene, that is the elevator pitch on the Amity BCI Equity Fund. I'm going to stop sharing and hand over back to you.
Rather, thank you very much. A lot of information there in a very short space of time, and I'm sure there's a lot more that can be discussed about the fund and a systematic approach. But just very briefly, as part of introduction, I mentioned to the audience that you are head of systematic solutions at Flagship Asset Management. The Amity Equity Fund, your approach is a little bit different. Just explain to me briefly again, what is the main difference between a systematic only fund and how you bring in systematic ideas into the Amity Equity Fund and how it differs to a systematic only fund?
Sure. Eugene, so a systematic only fund is, there is no intervention by humans in the process. Humans are working on the process, but the process is a production line and human emotions are never allowed to interfere with the portfolio. The portfolio is constructed in an optimal way from a systematic perspective. The way that this fund is different is that we also have a deep fundamental insight and a team of fundamental analysts and portfolio managers that add an additional layer of potential overrides to the strategy. And these come from two sources. The first is on the raw data that comes into the systematic production line. And in this case, the fundamental team might decide that actually the ROE of Naspers is too low because of X, Y, and Z. And therefore that we adjust the ROE for individual stocks upwards and downwards and every one of the other metrics based on our insights and our current perspective on the market. And then the investment engine takes all of that fundamental information and the risk information and constructs what it perceives as the optimal portfolio with high conviction. And then we revisit that portfolio before we trade and we say, okay, listen, this is a bit too much overweight to gold and too much underweight to Sasol, for example. Let's taper those two risks. There's a bit of too much idiosyncratic risk, too much of a risk taking on the gold price, for example. Let's manage those risks down and ensure that we build the best risk-adjusted portfolio for Amity and for our clients.
Thank you for that. And you showed on the one slide as well the Sasol example. We upweighted Sasol, but let's use Sasol maybe as an example, because I mean you made it very clear that intersection between growth, quality, and value. And we've had a couple of fund managers on that are almost benchmark agnostic, that bluntly state they won't touch Sasol with a barge pole because of the quality of management in the company, and there's a lot of questions around that. And I know some managers had some Sasol plays in their equity funds as an energy play, but not very much a loved stock. And if quality is part of your screening, how does that fit into your world?
Yeah, so Eugene, spot on. I'm not going to say that we disagree on any of those dimensions. And we were actually significantly underweight Sasol for a very long time based on the fundamentals. We agree that the quality was poor, quality of management was poor, it was expensive, and the growth was stagnant. But we started to buy into Sasol a couple of months, even before the Iran war started, because of the chemical upgrades and the potential chemical earnings coming through. And we closed that underweight further with the start of the Iran war, just purely from a macro risk management perspective. So our position in Sasol is a combination of a slight improvement in the fundamentals, but very much play on managing the risk in the portfolio.
I think it does provide some insight in terms of your process. And like I said, I'm sure there's a lot more to unpack here. But just quickly, a question from the audience. How does the mandate differ from the stand-up enhanced multi-style equity fund?
So the mandate differs in the way that the fund is an aggressive equity fund. The Amity fund has got much wider risk limits and therefore a much larger alpha targets. So it's an aggressive version with additional fundamental overlays of the investment engine that we use elsewhere.
Okay. And then also speaking to a question from the audience, if I look at your performance just over 3 months, and I know it's you can't judge an equity fund looking at 3 months performance, but on a relative basis, the fund had a really tough time. Maybe just take us through some of that. Is it because you steer away or drift far away from the benchmark being JSE capped all share, and that you look very different, or what can cause some of those short-term drags on the portfolios or the fund as we've seen the past 3 months?
Yeah, Eugene, I think that's a very valid and relevant question. And the underperformance of the fund has been driven largely by the fact that we've been underweight PGMs and overweight gold counters for quite a while in the portfolio. So even though we've tapered that risk down, we remain structurally underweight PGMs and overweight gold. And as PGMs outperformed gold over the last 18 months and the last year and the last 3 months, we've generated some underperformance because of that structural position.
Right, that does explain some bits of the fund, and we're going to keep an eye out on the fund. Radamari, I'm going to step off on local equity, and I want to go over to global equity to Philip. Philip, there's a whole bunch of questions coming in from the audience as well. So if we can maybe just start very quickly. And what would an investment discussion be if we didn't speak about currencies? But there is a question in from the clients as well, saying, what about Rand strength against the dollar over the next 10 years? And I think I know where this question comes from. We've had a couple of comments, from various presenters so far for the 6 months in the year, almost concurring that the dollar are perhaps in a cycle or going into a cycle of structural weakness. And I'm not talking about the short term and what's happening tomorrow, and we're not calling out what the dollar or the rand's going to be 3 months from now. But what is your view on the US dollar? Would you agree with that, saying that it was overvalued for a very long time and it can potentially remain under pressure for longer periods?
Yeah, that's probably the hardest question that you could probably put to me in terms of where currencies are going. What I will say is that if inflation is higher in South Africa than it is in the US, mathematically speaking, the ZAR will depreciate against the dollar. So that's one thing. And for the last however many years, forever, emerging markets currencies have, in general, have depreciated against the dollar because of the higher inflation, and that has to do with you can put that down to inflation differentials. Importantly, I think so that's the 10-year question, and I think if I had to put my head on a block, I'd say that South African inflation is going to be higher than US inflation over the next 10 years, and therefore it would depreciate. I think the trickier question is, let's say, what's happening over the next 1 to 3 years, and that would be a function of our trade of terms, or terms of trade, and that would be down to what is the oil price and what is the gold price, precious metal prices doing. So South Africa's largest, so our biggest import item on South Africa's income statement is oil and refined petroleum. I think it's about $200 billion annually. If that price goes up, we have to spend a lot more rand to buy those dollar-based products, and that's bad for our currency. And if precious metals prices goes up, which is our single biggest export, which coincidentally also sits at about $200 billion, then that's good for us. So if you, I'll leave it to the investor or to the person asking the question, make a call on the oil price versus the precious metals price. If you think oil is going to be higher than gold, ZAR will depreciate, and vice versa.
I tend to agree with that, and it is a tough one to call. Maybe a question that is, I think, a lot more relevant, and you had a very interesting slide up showing, earnings across the world of the ACWI, All Country World Index, which actually looked very impressive. But more specifically, and the audience member wants to know, is that consistent across regions or globally, or does it, or are there specific regions that actually contribute more than others to that positive earnings review upwards?
Yeah, great question. And I think I've been asked before, like, what is my view on emerging markets? And I think emerging markets aren't as homogeneous as what they have been in the past. You could always put emerging markets in one group, and they're quite clearly different these days. So if you look at emerging markets as a whole, earnings upgrades have been going up. But if you strip out South Korea and Taiwan, they've been largely flat relative to equity. So South Korea, with their two large names of Samsung Electronics and SK Hynix, which are the memory chip makers and make up 50% of the index, those have been going through the roof. It's been like triple digits already year to date in terms of share returns, and more than that over the last year. Taiwan Semiconductors, the largest contributor of Taiwan, that's also been going very well. So those two specifically have been going up. India flat, Japan up, Europe flat, and the US up. So, and as I showed, SA down to pretty much down from early this year, revisions have been going downwards. So it's really been, you've wanted to be in US, Korea, Taiwan, and Japan.
Japan is very interesting indeed, especially looking at their currency. We all know that the yen is massively undervalued. So if you get an equity opportunity right in Japan, and the currency actually picks up a little bit, it could be a double bonus in portfolios. But just on Japan, what are some of the names or counters that you are looking at the moment in Japan, and what is your exposure there in the overall portfolio?
So one that we added early on this year is Sumitomo, and they actually are involved in making the wafers, which is what the silicon chips are basically printed on. So it's great looking when you've got the global space to look at. You can look at, for example, NVIDIA, which has done well for a couple of years, and then you say, well, what actually goes into NVIDIA? And you go, oh, well, maybe it's these lithography machines and these chip makers. Okay, but what goes into the chip making machines? And then you find a lot of these sub layers of these companies actually sit in Japan. So Sumitomo is one, they make one of the layers. A very interesting one as well is Advantest, and that's how you actually test the semiconductor equipment that these, like it'll test to how good the machine is made, how effectively it's running. So it's what makes my job very, very interesting and lots of fun is I get to explore all these different avenues of how to play, let's say, for example, the AI play in so many different levels.
Speaking of AI and emerging markets, you touched on briefly as well, and you've got exposure to Taiwan Semiconductors. But if we just isolate emerging markets, there's again high concentration, similar to what you see in the US with some of the hyperscalers. So in emerging markets, you've got Samsung, Hynix, you've got Taiwan Semiconductors. I think that probably dominates the emerging market index. Are there perhaps in the AI space more unloved companies that you would start to pull into the portfolio, but where there's not necessarily so much price momentum at the moment?
I had a name in mind until you said price momentum, because one that's still very cheap and one we feel is underappreciated, but has done over 100% since we bought it earlier this year is Micron. And it's now just entered the top 10 global companies by market cap. Now, I do truly appreciate the fact that the memory companies are cyclical in nature, and they always have been very cyclical, and they've been very commoditized because these little memory chips used to go into phones and to cars and fridges and whatever, and very simple machinery. As they've entered the AI space, they've become a lot more complex. And for the first time, they've entered long-term agreements between 3 and 5 years long. So they've never had long-term agreements because the companies were always cyclical. So a large part of the cyclicality has been removed from a company like Micron. And there's only 3 companies that make this type of high bandwidth memory, which is Samsung Electronics, SK Hynix, and Micron. And Micron being the only US producer. And so I'll put it to you this way, and why we've pulled it in to the portfolio is that it's currently trading on a 10 times forward PE, where you've got all the other AI players trading at 20 to 60 times forward. And if we look at the PEG ratio, which looks at the 3-year forward growth rate below the PE, and that's sitting at a 0.1 times, where you've got the S&P PEG ratio of about 1.2 times. So it's very, very cheap. The cyclicality has not completely been removed, but it has a large part of it has been removed, given that now over 50% of revenues are locked in at very good margins and good prices for the next 5 years. So that's what I think, and it's the largest position at the moment.
Thanks, Philip. Let's just talk about Flagship and your approach a little bit. You did make mention, you were one of very few companies in SA that actually are predominantly focused on global equity. You've been doing it for a very long time, and I would say, the proof is in the pudding. And if I look at the Flagship Global Equity Fund, just the performance numbers, you are getting something right. Because there's consistent outperformance on the ACWI, yet the holdings that you showed are very different to a lot of fund managers that we see. It's very different to the benchmark. In a nutshell, what is your approach at Flagship that gives you the edge and keeps on delivering on performance for clients?
A great question, and I'll try to keep it as nutshell-ish as possible. And that is, our process can be put into one term, and that's we let our winners run and we cut our losers very quickly. So that's the main thing. The second big thing is that, and I'm not sure if I haven't seen this before, but with other managers, but we are sector neutral. So we are stock pickers. Certain sectors can re-rate and de-rate, and with the same earnings. So we don't like to try to call where things can rate and re-rate. We look at earnings very, very much as a priority. We are sector neutral, yet we have an active share of 85%. So
Okay.
you will see, as you said, we don't look anything like the benchmark, but yet we do remove the risk of being under or overweight sectors.
Thank you for that. I think that does explain exactly what you do at Flagship. So you are active indeed. I'm going to take one more question from the audience, and it's very relevant from an SA investor perspective. So Sean wants to know, if you look at asset allocation from an SA investor perspective, and you want to protect assets in terms of global wealth, but you still want to support SA debt or earnings, and typically, you put in brackets there, typically if we had a lot of global equity exposure, you would hedge that with SA bonds. Do you think that's still the route to go if you have global equity, regardless of the percentage, that you would hedge some of that with SA bonds?
No, I don't. Let me put it to you this way. I think that the younger you are, so I think it's an age question. I think the younger you are, the much more exposed you should be to equities in general and global equities specifically. And as you age and you have liabilities which are due on a monthly basis, as you go up that or lower on that risk curve, then you want to be more exposed to an income providing type of bond. But I think that having said that, I think that even into older age, you should still have a satellite component to your total portfolio, which should be global equities, just to counter that weaker ZAR and the higher inflation that SA equities are exposed to.
But a very, very last one, just quickly, the two mandates, global equity and worldwide flex. Worldwide flex has been going for a very, very long time. But that, if you look at the asset allocation, are predominantly equity, and it's global equity. What's the main differences between your two mandates? So if I want to include Flagship in my clients' portfolios as part of a global exposure, which mandate should I use?
Great question. And the answer, fortunately, is quite simple. If you're looking for the best absolute return, invest in the global equity. If you're looking for the better risk-adjusted return, invest in the flexible fund.
As simple as that, and there you have it. Gentlemen, I'm going to pause it there, and to our audience, thank you for the great questions that came in as well. Radamaya, thank you so much for providing good insight into the Amity Equity Fund and how you manage that fund. Very interesting indeed. And I know you've got a lengthy track record as well. Philip, thank you so much for your time this morning. Flagship funds definitely is something you should consider if you're looking at global equity. And I always say, like I said before, the proof is in the pudding. Jens, thank you so much for your time this morning. To our audience, thank you for your time. Quick reminder, next week, Wednesday, the 8th of July, we're continuing conversations, and we've got Methodical coming to join us, looking at the equity portfolios. Gentlemen, thank you. To our audience, have a super week further.
Thank you for